Hey everyone, welcome back. Today, we're talking about something that's been on a lot of minds recently: what to do with your money when interest rates fall. You might already know that interest rates affect things like your savings account and mortgage, but there's so much more to it. So, what do lower interest rates really mean for your finances, and how can you use this to your advantage? So, here's something many people don't think about. When interest rates drop, it doesn't just impact borrowing. It also changes how your savings and investments work for you. This can be a big deal if you've been enjoying those higher returns on your savings account, or if you're thinking about buying a home. Lower rates can feel like both a good and bad thing, depending on how prepared you are. And in today's talk, we're going to go over a few key areas: what happens to your savings, how it might affect your investments, and some practical steps you can take to make sure your money is still working hard for you even when interest rates are low. By the end of this, you'll have a clear idea of how to navigate this environment, so stay tuned because this is going to be really helpful for anyone looking to make smart financial decisions in the months ahead. First off, let's talk about savings accounts. Many of you might have noticed that savings account interest rates have been surprisingly high lately, but with lower rates coming, those gains are going to start shrinking. So, if you've been relying on that high yield to grow your cash, it's time to start thinking about alternatives. But here's the catch: keeping too much money in a low-interest savings account means you're not maximizing the potential of your funds. So then, what's the next step? You don't want to abandon your emergency fund, but you also don't want to keep more cash than you need sitting in a low-interest environment. Now, what about those of you thinking of locking in rates with CDs or bonds? Well, here's something to keep in mind. If you've been considering a certificate of deposit or treasury bond, you might want to act sooner rather than later because banks tend to lower CD rates quickly once the Federal Reserve cuts rates. So, if you want to lock in a decent return, you have a small window before those opportunities start to fade. Speaking of bonds, let's talk a bit about investments. When interest rates drop, bonds that were issued when rates were higher become more valuable. Why? Because those older bonds pay a higher return, making them more attractive than newly issued ones. So, if you're holding bonds, especially ones with higher yields, they might start looking pretty good. And if you're planning to invest in new bonds, you might want to consider bond funds that focus on high-quality government or corporate bonds. These can provide decent returns without the risk that comes with chasing stocks or other volatile assets. And next, we've got real estate. You see, lower rates typically mean lower mortgage rates, which can be a great opportunity if you're thinking about buying a home. Lower borrowing costs can help you afford a bigger place or save on monthly payments. But even if you're not in the market for a new home, you might want to keep an eye on real estate investment trusts or REITs. These tend to do well when rates drop, as more people buy property and developers ramp up new projects. Now, I know some of you might be wondering, what about stocks? Should you shift more of your money into the market? Well, this is where it gets a bit tricky. Sure, lower interest rates can boost the stock market because companies can borrow more cheaply and consumers have more money to spend. But here's the thing: you should only invest in stocks if you're in it for the long haul. Short-term gains are tempting, but they can be risky, especially if you're putting money into volatile sectors just because the rates are low. Another thing to consider is the middle ground: the money you won't need right away, but also won't be locked up for decades. For this, building a bond or CD ladder can be a solid strategy. By staggering your investments across different maturities, you can balance the risks and still get a reliable return even when interest rates are unpredictable. Besides that, don't forget about diversification. With rates changing, it's more important than ever to spread out your investments. A mix of stocks, bonds, and real estate can help cushion any market shocks and make sure you're prepared for whatever comes next. You don't want to rely too heavily on one thing when the market is shifting. So then, where does all this leave us? Well, when interest rates are low, the key is flexibility. Whether it's your savings, investments, or even big purchases like a home, the goal is to stay adaptable. Lock in rates where you can, but don't be afraid to adjust your strategy if the market changes. And, most importantly, don't just leave your money sitting idle. Find ways to make it work for you. Now, before we wrap up, I want to hear from you. Have you been noticing changes in your savings rates or thinking about how these lower rates are going to affect your investments? Drop a comment below and let's chat about what steps you're taking to adjust. I think we all have something to learn from each other when it comes to navigating a changing financial landscape. Thanks for hanging out today, and remember, whether rates are high or low, the most important thing is to have a plan and stick to it. Stay smart, stay informed, and I'll see you in the next one.